Welcome to this first topic of our course on ethics and governance. In this lecture, I want to give you a clear and comfortable introduction to corporate governance, what it is, why it exists, who is responsible for it inside a company, and how it works here in Malaysia. Think of this video as the guided explanation. I will take the ideas slowly and in plain language, and your textbook carries the full detail, the diagrams, and the references for when you study afterwards. You do not need any background in finance to follow along. Every new term will be explained the moment it appears. By the end, you will be able to say, in your own words, what corporate governance means and why the entire financial world takes it so seriously. Let us begin. Let me open with a question, and I would genuinely like you to pause and think about it before I give you the answer. Imagine a company has just announced record profits. Its share price is climbing, the analysts are praising it, and the newspapers are calling it a great success. Here is the question. Does all of that, by itself, prove that the company is well run and trustworthy? Most people instinctively answer yes. Surely strong profit must mean strong management. It feels obvious. But I want you to hold that thought, because by the end of this lecture, you will understand why the honest answer is not necessarily. A company can be enormously profitable and still be very badly governed, and that gap between looking successful and being well run is exactly where ordinary investors get hurt. People put their savings into a company that looks wonderful on the surface and lose everything when the weak governance underneath finally gives way. To understand how that happens, we will build this topic around 4 questions: what governance actually is, why it needs to exist at all, who is in charge inside a company, and how all of this is organized here in Malaysia. Keep that opening question in mind. We will come back to it directly. Before we define the term, I want to show you that corporate governance is not just an abstract classroom idea. There are real, powerful institutions whose entire job is to set it, enforce it, and benchmark it. And you should know their names because they appear throughout this course. Let us go left to right. Here in Malaysia, start with the Securities Commission, which we shorten to the SC. The SC is our capital market regulator, and crucially, it is the body that issues and updates the Malaysian Code on corporate governance, the MCCG. So whenever you hear the word MCCG, I want you to immediately think SC. Next, still in Malaysia, Bursa Malaysia, our national stock exchange, the marketplace where company shares are bought and sold. Bursa matters for governance because its listing requirements force every listed company to disclose how it is governed. And remember this idea because it returns again and again. Without disclosure, governance is invisible. If a company never has to tell you how it is run, you can never judge it. Finally, going global, the OECD, the Organization for Economic Cooperation and Development. The OECD publishes principles of corporate governance that are recognized around the world as the benchmark, and our own MCCG is modeled on them. So notice the chain of influence. The OECD sets the global standard. The SC adapts it into Malaysia's MCCG, and Bursa makes companies disclose against it. 3 names, 1 connected system. Let me set out clearly what you should be able to do by the end of this topic, so you always know where we are heading. First, define corporate governance and name its 4 core principles: accountability, transparency, fairness, and responsibility. Second, explain the agency problem, which is the underlying tension between the owners of a company and the managers who actually run it. Third, identify who holds responsibility inside the company. That is the board of directors, and explain why we place so much value on independent directors. Fourth, and this is the real thinking skill, Judge whether a company that is highly profitable is actually well governed. And fifth, describe how the Malaysian Code on Corporate Governance guides practice here at home. Notice that we climb gradually. We start by simply remembering definitions, and we end by exercising genuine judgment. The textbook expands every one of these outcomes with worked examples and review questions. Here is the path we will travel. 5 short connected stops. Stop 1. What corporate governance actually is in plain words, together with its core principles. Stop 2. The agency problem. The reason governance has to exist at all. And I promise you, once this single idea clicks into place, everything else in the course becomes easier. Stop 3. The board of directors and the meaning of independence, who sits at the very top of a company, and why we insist that some of them be genuine outsiders. Stop 4. The important lesson that strong performance does not prove good governance. This is where we answer our opening question and sharpen our judgment. And stop 5. How governance actually works in Malaysia through the MCCG. Each stop leads naturally into the next, so the whole topic reads as one connected story rather than a random list of facts. Let us begin with the foundation, what corporate governance actually is. In this first section, I simply want to give you a precise, memorable definition and a small set of principles that sit underneath it. Keep it simple for now. We are laying the first stone of the whole subject. So here is the definition I want you to carry with you for the rest of the course. Corporate governance is the system by which a company is directed and controlled. Say those last 3 words again slowly. Directed and controlled. Governance is about how a company is run and held to account. It is not about how much profit the company makes. Let me make that concrete with a simple picture, the governance chain. When you buy shares in a company, you become one of its owners, but you do not show up at the office and run it. You cannot. There may be thousands of owners. So the owners, the shareholders, appoint a board of directors to set the company's direction and to watch over it on their behalf. The board, in turn, oversees the managers, the chief executive, and the team who actually run operations day to day. Now, every link in that chain is a point where things could go wrong. Managers might serve themselves instead of the company. The board might fail to supervise them. The owners might be kept in the dark. Corporate governance is precisely the framework of rules, oversight, and accountability that keeps that chain honest, so that the people running the company genuinely serve the people who own it. That is the whole idea in one sentence. And your textbook draws this chain out in full with a diagram. Good corporate governance rests on 4 core principles, and I want you to be able to explain each one in a single sentence, because everything else in this course flows from them. The first is accountability. Accountability means that decision makers must answer for their actions and accept the consequences. A manager cannot simply make a decision and disappear. Someone can require them to explain and justify it. The second is transparency. Transparency means timely and accurate disclosure of how the company is run, its accounts, its risks, its decisions, so that owners and the market can actually see what is happening rather than guessing. The third is fairness. Fairness means that all shareholders are treated equitably, and in particular, that the rights of minority shareholders, the small investors, are protected against abuse by the controlling owners or by management. Imagine a majority owner who arranges sweetheart deals for himself at the company's expense. Fairness is the principle that stands against exactly that. And the fourth is responsibility. Responsibility means the company acts within the law and meets its obligations to its wider stakeholders, employees, customers, creditors, society, not only to shareholders. Accountability, transparency, fairness, responsibility. If you can define and illustrate each one, you understand the spine of this entire subject. Now we come to the single most important idea in the whole topic, the reason corporate governance has to exist at all. It is called the agency problem. I'm going to ask you to slow down and really absorb this one, because once you understand it, every rule, every committee, and every code we discuss afterwards will make complete sense. The agency problem begins with one simple fact about modern companies. Ownership and control are separated. The people who own the company, the shareholders, provide the money, but they do not manage the business. They hand that job to professional managers who run it on their behalf. In the language of governance, the owners are the principals and the managers are their agents. An agent is simply someone who acts for someone else. Now here is where the trouble starts. The principal and the agent may want different things. The owners want the long-term value of their investment to be protected and grown. But a manager is a human being with their own interests and might be tempted to put those first, to pay themselves a very large salary, to chase prestige and empire building through risky acquisitions, to enjoy perks, or to hide bad news to protect their job, even when none of that is in the owner's best interest. That conflict of interest between the people who own the company and the people who run it is the agency problem. Let me give you a quick example. Suppose a chief executive is offered a bonus for hitting this year's profit target. He might cut spending on safety or on long-term research to make this year look good, collect his bonus, and leave the damage for the owners to discover later. The incentives are misaligned. So here is the punchline, and it is the key to the whole course. Corporate governance is, at its heart, the set of mechanisms we designed to control the agency problem, to keep managers accountable to the owners they are supposed to serve. The board, independent directors, audits, disclosure. Every tool we will study is ultimately an answer to this one problem. If governance exists to control the agency problem, the natural next question is who inside the company actually does the controlling? Who sits at the top and carries the responsibility for keeping management in check? That is the role of the board of directors, and it is the focus of this section. Inside the company, the body that holds ultimate responsibility for governance is the board of directors. Let me be clear about what the board does. It sets the company's overall direction and strategy. It monitors and supervises management, and it protects the interests of the shareholders who appointed it. The board is the owner's representative at the top of the company. Now here is the crucial refinement, and it is one students often underestimate. For the board to do its job honestly, some of its members must be independent. What does independent mean? An independent director is an outside director who has no business relationship, no employment, and no family ties to management. Someone with no personal stake that would stop them asking a hard question. Why does that matter so much? Picture a board made up entirely of the chief executive's friends and subordinates. When the chief executive proposes something self-serving, who will challenge him? Nobody. They all depend on him. That is a board in name only, a rubber stamp. Independent directors break that dependence. They can say no, and they can ask why. Independence is what gives the board's oversight real teeth, rather than being a polite formality. One board committee deserves an early mention because it appears throughout this course, the audit committee. It is made up mainly of independent directors, and its job is to oversee the company's financial reporting and internal controls. In other words, to make sure the numbers can be trusted. We will meet the audit committee again. For now, hold on to two things. The board is responsible, and independence is what makes that responsibility meaningful. We now reach the lesson that ties this whole topic together, and the one that finally answers the question I opened with. It is the idea that a company's performance, its profit, does not, by itself, prove that the company is well governed. Let us see exactly what that means and why it matters so much. Let us return to our opening question. A company posts record profits. Is it well governed? And now you are ready for the honest answer, which is not necessarily. Let me show you why with a scenario very much like the ones you will meet again. Picture a company with soaring profits and a rising share price. Wonderful on the surface. But look underneath. Its board is dominated by executive directors, which means there is no real independent oversight. No one to challenge management. Its key decisions are barely documented, which means there is no transparency, and its shareholders are given almost no say and almost no information, which means there is little accountability. And here is the trap. No law has been broken. Everything is technically legal. Yet every single pillar of governance we have learned, independence, transparency, accountability, fairness, is failing. So what is really going on? This company carries high governance and agency risk despite its strong financial performance. The profits are real today, but there is nothing protecting them, nothing to catch a problem early, nothing to stop management from serving themselves. The deep lesson is this: profit is a result, while governance is the system that produces results you can actually trust. So when you are handed any company, in an exam, in the news, or in real life as an investor, do not let the profit dazzle you. Deliberately look past the bottom line and check three things. Is the board genuinely independent? Is the disclosure honest and complete? And are the shareholders respected? Judge the governance, not the profit. That single habit of mind is the most valuable thing this topic will give you. Finally, let us bring everything home to Malaysia. We have been talking about governance in general terms. Now I want to name the actual rule book that Malaysian companies follow and explain in practical terms how it works. This last section is short, but the names in it are ones you should know precisely. In Malaysia, the main guide to how companies should be governed is the Malaysian Code on Corporate Governance, the MCCG. I want you to remember three things about it and to understand, not just memorize, each one. First, who issues it? The Securities Commission Malaysia, the SC, the very same regulator we met at the start of this lecture. So if anyone ever asks you what primarily guides corporate governance in Malaysia, the precise answer is the MCCG, issued by the SC, not Bursa's rules on their own, and certainly not the old Companies Act. Second, its style, and this is the clever part. The MCCG is principles-based, and it works through an approach called apply or explain. That means a company either applies each recommended best practice, or if it chooses not to, it must publicly explain why and describe the alternative it has adopted instead. Think about how elegant that is. It does not force every company into an identical mold. A small company and a giant bank are not treated as if they were the same, so it is flexible. But it is also transparent, because a company cannot simply ignore the code in silence. It has to account for its choices in the open, where shareholders and the market can judge them. Flexibility plus transparency is how a code that is not strictly law still manages to raise standards. Third, how the code actually reaches companies through Bursa Malaysia's listing requirements, which compel listed companies to disclose their governance to the public. And notice, finally, how the whole topic ties together right here. The MCCG is built on OECD principles issued by the SC, applied through apply or explain, and enforced through Bursa's disclosure. One connected system. Before we close, here is the whole of this topic on a single page. I would like you to keep this picture in your head. At the center, in gold, sits the big idea, corporate governance. Branching out from it are our 5 threads. 1. The definition and the 4 principles: accountability, transparency, fairness, responsibility. 2. The agency problem, the conflict between owners and managers that governance exists to control. 3. The board and independence. The board carries ultimate responsibility, and independent directors keep its oversight honest. 4. Performance does not equal governance. The judgment skill that strong profit can conceal weak governance. And 5. The MCCG, Malaysia's National Code, issued by the Securities Commission and applied through apply or explain. See how they connect into one story. We define governance, we expose the problem it solves, we identify who is responsible, we learn to judge it, and we bring it home to Malaysia. If you can talk a friend through this map from memory, you have truly understood the topic. Before we close, here is the whole of this topic on a single page. I would like you to keep this picture in your head. At the center, in gold, sits the big idea, corporate governance. Branching out from it are our 5 threads. 1. The definition and the 4 principles: accountability, transparency, fairness, responsibility. 2. The agency problem, the conflict between owners and managers that governance exists to control. 3. The board and independence. The board carries ultimate responsibility, and independent directors keep its oversight honest. 4. Performance does not equal governance. The judgment skill that strong profit can conceal weak governance. And 5. The MCCG, Malaysia's National Code, issued by the Securities Commission and applied through apply or explain. See how they connect into one story. We define governance, we expose the problem it solves, we identify who is responsible, we learn to judge it, and we bring it home to Malaysia. If you can talk a friend through this map from memory, you have truly understood the topic. That brings us to the end of this introduction. Let me leave you with the 5 ideas to master, because together they are the foundation for everything that follows in this course. 1. Be able to define corporate governance, the system by which a company is directed and controlled, and name its 4 principles. 2. Explain the agency problem, the conflict between principal and agent, between the owner and the manager. 3. Know that the board of directors holds ultimate responsibility, and explain why independent directors matter, to make oversight real and to reduce conflicts of interest. 4. The big one, be ready to judge a profitable company and to see clearly that strong performance does not prove good governance. And 5. Remember that Malaysia's governance is guided by the MCCG, issued by the Securities Commission and applied through apply or explain. Please read the full chapter in the textbook. It carries the detail, the recent real-world cases, and the references behind everything I have said today. Thank you for watching, and I look forward to seeing you in the next topic.